ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Dio, what is popping today?
JC, we have 3 books on the table used as our centerpiece today.
Mm-hmm.
First time ever that these books have made an appearance.
They look boring as hell.
Possibly, John, possibly. Now, some people are tuned in right now on audio only. They're like, what are they talking about? Hey, y'all, slide over to YouTube. Give us a subscribe, and you'll be able to see the centerpieces that we discuss.
Okay.
But there's 3 books.
Yeah.
2 books are regarding investing in real estate, becoming a millionaire in real estate.
Mm-hmm.
And 1 book is a book on negotiating tactics.
Okay. What's the third?
No, there's 3 books.
Oh, did you name 3?
No, I said there's 2
Oh, okay. Yeah.
that are real estate related, real estate
Right.
investment related, becoming a millionaire related.
And then I said, what's
And then
the third?
There's 1 book.
Yeah, the third.
That's the 3rd one.
Correct.
Okay, yeah. Never Split the Difference is the name of the book.
Never heard you talk about it before.
And that particular book
Mm-hmm.
is more around how to properly negotiate.
Okay.
Of these 3 books, I have read 1 twice, and I have read the others 0 times. Although I own the books, I have owned them for going on 20 years, and I've opened both of them.
They look like books that I used to take back from the school library at the end of the year in college and resell. I used to make a killing doing that.
Wait, you would take books from the library?
No, like, like the bookstore, the collegiate
Yes.
bookstore, everybody had that buyback program. Back in the day, children, yes, we used to have books we used to have to buy. And what I would do when it's time to, sell back, I would just go upstairs in the bookstore, take a bunch of expensive books, like $300 and up, and then sell them back downstairs for, quick $500 profit. If they still do that, I will do it without a student ID to this day.
That is one of the biggest grifts ever.
That's a
you
good.
Are, you are announcing on this show your adolescent
Hijinks, bad behavior.
bad decisions.
What are you talking about? What is it? Year of stipulation?
Grand theft.
What is it, like stipulation?
Grand theft.
Time of stipulation where it happened so long ago I can't be.
Statute of limitations.
That thing. There you go.
Yeah, the statute of limitations has worn out. As
Yeah.
John Coleman successfully grifted the University of Tampa,
Show.
selling them back their books
Hey, I did it.
from upstairs
Yeah, I've done
downstairs.
it. Shout out. Yeah. I should have told the UCF kids that. Would have saved them some money.
Yeah, I don't think the UCF College of Business would have appreciated that, and we wouldn't have received our invite back, John.
Shout out, but it doesn't matter. They don't use books anymore. They probably download apps that are only good for 1 semester. Isn't that not right?
They probably do.
Okay.
They probably do. No, but it's interesting that the 2 books I have on here are 2 books that back in the day were New York Times bestsellers. They were 2 books that were recommended to me by a buddy of mine who was really big into real estate investing. And I believe both of the books are written. One of them was actually written by Gary Keller of Keller Williams fame.
Is that really the Keller?
Gary Keller. Yeah. So it's the Millionaire Real Estate Investor. And then there's a book that was titled Flip. And the foreword was written by Gary Keller, but the actual book itself was written by 2 dudes named Rick and Clay.
Okay.
Today's episode
Yeah.
is going to be 5 ways to make millions in real estate.
No shit.
Yeah. Taught to you by a serial mortgage professional who just so happens to own 2 homes, who just so happens to also have for the past 3 years owned a successful fix and flip, buy and hold real estate development company.
How many times you've been through the home buying process total with your investments and personal?
I have to attend a closing just about every week.
Really?
Every week. Like I'm signing documents.
You learn something new every time? Or is it same time, something's rinse and repeat, but every once in a while there's a new wrinkle thrown
I
your
think
way?
you learn something new every transaction.
Okay.
Right? I think you learn something new anytime you go on an adventure. Right? That's part of life. Life is learning. So I think becoming a career learner makes life more fun, especially when you're only learning things that you're interested in or things that you're probably naturally good at.
Right.
So we're going to talk about things that I know from personal experience. It's interesting. I didn't learn it from a book, but I am featuring 2 books that could potentially teach it to you. The problem is these books are so outdated that when you start reading them, they talk about marketing tactics and strategies. That here's what's interesting. 70% of the marketing strategies still work today. Because if it's new,
It ain't new.
It's not true.
Damn it.
And if it's true, it's not new.
That's what I meant to say.
But there is a good third that reminds us why we need to embrace technology and why we need to lean into the modern era, because the third of it's like, yeah, I'm pretty sure that wouldn't work today. But what you would then need to look, if you went and read these books, is like, okay, it works. It's just called something different. All right, cool. So that's what today's episode is going to be all about.
Let's go.
Right? This is going to go towards literally anybody who is looking to make millions in real estate, which for most people, their home is their largest asset. If they purchased a home in their early to mid 30s and they owned that piece of real estate or a piece of real estate, maybe they bought a house, 7 years later they sold it, they used the equity from that sale to purchase another property, and maybe they did it one more time. Eventually their goal is to get to a point in their life where they're in their 60s and they own their home free and clear. And that asset that could be worth $300,000 or $3 million, that asset is one of their largest, if not their largest asset. Real estate is how most people become millionaires. Okay. So we're going to talk about that, but we're going to talk about firsthand experience, less about the books I've read, because as a learner, that's how I've always loved to learn. My favorite professors at UCF were adjunct professors, right? Whether it's Dr. Morgan or Dr. Stansberry, I appreciated professors that had worked for Coca-Cola, that had worked in crisis PR, that had to testify in front of Congress. Like, they had real world experience. Yes, they had a PhD. Yes, they are also into academia, but they came and taught. When we get on the show, most things that we talk about because I know them from firsthand experience. I'm not sitting in front of this mic with you as my audience, my producer, and my co-host, having conversations based on something I learned in a book. I do talk a lot about books, such as Never Split the Difference. Yes, this book is on the table today because I just finished it. It's my trophy.
2X read.
It is a 2X read. Yes, this is maybe the second book I've ever read twice. The first one was Atomic Habits, which I talk about a lot on the show. And the second one is Never Split the Difference by Chris Voss. Just completed it. Now I'm going to give myself a break, and I am deep into Matthew McConaughey's Green Lights.
What?
Awesome book. Matthew McConaughey wrote a book about a year or two ago.
Is it about aliens?
It's phenomenal.
It's about aliens, green lights?
No, it's about his life and the lessons learned. He's a pretty introspective dude who's a good writer who obviously has lived a lot of life. He's 50-some years old, and he's had successes and failures, and he talks about that.
You talk about them weirdo Lincoln commercials where he's driving through the desert?
Not yet. I haven't made it that far. Right now, I'm at a point in the book where he was an exchange student in Australia.
Damn.
And he was about 18, 19 years old, did an exchange program through the local Rotary Club.
There you go.
Yeah. So anyhow, today's episode is brought to you by Dio's Life Experience.
And books.
And more books. Yes. Before we get too far into it, I do want to remind everybody, especially our mortgage loan originators, right? We're doing an event for mortgage loan originators in Jacksonville, Tuesday, May the 23rd. It's 11:30 to like 4:30. It is a free event, but it's free because we have awesome sponsors: Landmark Title, Cross Country Mortgage, the Mortgage Bankers Association of Jacksonville, and Fiber Mortgage have all stepped up to the plate. They're providing the space. They're providing the food. They're helping get the word out. And I think they can hold up to 100, but only 100. And unlike our other events, like this is going to be an event that the Mortgage Bankers Association Jacksonville is promoting, right? These mortgage companies are promoting. This title company is promoting. We've already had a lot of interest. But if you are interested in learning from top producers the tactics and strategies that they use today to fund their 20, 30 units a month, this event's for you. If you're looking to be entertained, maybe laugh a little bit, we have Steve Richmond speaking.
Shout out, Steve.
I promise you, Steve will entertain you. Steve will make you laugh, and Steve's also going to make you think.
Yep.
He's going to motivate you. So you want to attend this event. Check out our website, tloponline.com, and JC will have all of the information on the front of the page. That's also theloanofficerpodcast.com. Same website, two different names, just depending on which way you prefer to go.
Word.
All right. So, John, what do you know about real estate?
That it's the number one way to generate wealth in America. Because you taught me that incessantly.
Did I?
Yeah.
But your mom taught you that too,
Yeah,
did she not?
She dabbled in real estate like back in the day, like with investment properties and condos or whatnot. But Yeah, it's always been kind of around. I've
Yeah.
always known about it.
Yeah, you've always known about it, and your parents, who are both educators, they did well in real
Yeah,
estate.
yeah, they did.
Yeah, right? I mean, being an educator is a phenomenal career, but I don't think someone gets into education saying, oh my gosh, I'm going to amass a bunch of wealth.
No.
No, but you can earn a good living. You can earn yourself a pension, and then you can save and then to use that savings to go purchase real estate. And why I've always enjoyed real estate as an investment, it's the one investment you can go borrow money to do. Like, I can't go borrow money to go buy a bunch of Apple stock. Like, they don't allow that to happen, but I can go borrow money to purchase real estate. So we're going to quickly cover 5 ways that I personally know, more than likely as I've experienced it or experienced parts of it, 5 ways that people are making millions in real estate, and it's at all levels. So we're going to start at the very basic level, the traditional, because if it's not new, it is
Not true.
It is true.
Damn it. Are you
switched
come
up
on, man.
on purpose. On purpose.
I'm not
see
good
if
with
you were
these
listening.
tests,
Yes.
man.
If it's new, it's not true.
Okay.
If it's not new,
It's
then it's true.
true.
Then it's true. Yeah. So tried and true, traditional.
Yeah.
Tried and true. Like, we've done episodes on house hacking. Okay, tried and true. Here's what y'all do. You go buy a primary home. You put 0 to 3% down. Now, you have to qualify. So what does it mean to qualify? You have to have decent credit. You have to have a steady income with provable income, like steady employment with provable income. And you have to be able to come up with some money for down payment and potentially closing costs. Now, truth be told, you could, in certain markets, negotiate for the seller to cover your closing costs. So you could essentially, certain loan programs, VA home loans, USDA home loans, there's some proprietary products out there, like Waterstone Mortgage has this product called the Powerhouse 100. It's 100% financing. So you could be eligible and qualify for 100% financing. You could get the seller to pay all your closing costs, at which point you literally could get into a house for less money than it takes to rent an apartment. Because you rent an apartment, they typically want first month, last month, and security deposit. But let's say that's not you. You still can buy a house with 3 to 3.5% down. You would need another probably 3 to 3.5% to cover closing costs. So you would need some chunk of money to help you get in the door. But once you get in the door, you can own that home. You can live there for 2, 3 years, 5 years, however long it takes you to live there. As you live there, your home, on average, it is going to appreciate. Barry Habib, our friend over at MBS Highway, Barry has this phenomenal slide that he uses in his presentations, and it's something along the lines of home ownership is 73, 7, and 1. Meaning, like, out of the past 80 or 81 years, home ownership or home values have gone up like 73 times. They've gone down 7, and they've stayed the same like once. And I'm paraphrasing. I'm sure I butchered the exact numbers, but you get the drift. So when you're purchasing real estate,
It's a safer bet.
it's based on history.
Yeah.
Based on history. If history rhymes, then this is what it's going to sound like. It's going to sound like there's a good chance your home's going up in value. And then also when you're making your mortgage payment, you're paying your loan down. Paying your loan down is literally putting money into your house. That's the equity. Well, I originally owed $300, but after 5 years, I now owe $285,000. My home was originally worth $300,000, but after 5 years, do some quick math for you guys at home. Let's go 9, 18, 27, 32. Your home's up in value by roughly $50,000. What? So in 5 years, my home's worth $350, and I owe $285. That's $65,000 for doing what? Basically paying your bills on time. For basically coming up with enough money for down payment. Maybe down payment and closing costs. And your down payment could be 0. It could be 3.5%.
So if you say I have $65,000, how can I go to the ATM and pull out that money? How do I get that money?
Well, it doesn't really work that easy, John. It doesn't work that easy. That's why I'm a big proponent when I'm giving advice to home buyers. Like, look, let's not like dump all your cash into this house, because you might need that cash for a rainy day. You might need that cash for a college savings plan. You might need that cash for a retirement account. And it's not easy to get out, but that is your money. No, you would get it out by either taking a loan against your house or by selling your house. Both aren't necessarily the easiest things to do, but the good news is in just 5 years, you've amassed $65,000 in wealth. Most people, they couldn't have saved that. They couldn't have saved, well, they ended up being $10,000 a year. Most people can't save 10 grand a year. So like, that's just an easy, oh, wow. And then what if you did that again? And by the way, you kept the first house and now you rent it. And you just went and bought another house. And 3 to 5 years later, you did it again. And 3 to 5 years later, you did it again. And then 10 years later, you did it one last time, but this time you moved down because maybe your kids are grown and you want a smaller house. But you now own 5 homes that you have renters in. And all 5 homes for the past 10, 20 years, they have been increasing in value while a renter pays your loan down. And now each house has $200,000 or $300,000 of equity, at which point times 5 houses, there's $1 to $1.5 million. That easy. It's boring. It's methodical. It's a long play, but that is how you would become a millionaire in real estate, never doing anything balls out risky, never having some crazy idea, literally buying a home for you and your family to live in an area that is safe and sound and comfortable. And yet, instead of selling the home, what you're going to do is every 3 to 5 years when it's time, you're going to save up enough for another down payment, enough for the closing cost, and you're going to go buy another house while keeping the first house you bought. That's called house hacking. Now, there's some people who take house hacking to an extreme, and dude, kudos and high five to those people. That's not for today's episode. So then the other way people can make millions is you can become a real estate investor where you fix and flip homes. That's what you do. That's what these books on this table are representing, the fix and flippers out there.
Those are the fun shows on TLC where it's easy. I just go in there, buy a shitty home, put some paint on it, and sell it for hundreds of thousands over market retail value.
Sure, John. 100%, except for it's not easy.
Right.
Like, and that's what everyone has to understand. If it was easy, everyone would do it. I tell that to loan officers every day when they complain because an appraisal came in low, because a home buyer isn't giving them the documents that they need in time, because they don't agree with the underwriter, et cetera, et cetera. I'm like, yes, you get paid because things go sideways. You get paid to keep calm and to navigate the troubled waters to get someone from point A to point B, which is home ownership. But if it was easy, everyone would do it.
Yeah.
So it's not easy. Same thing goes with fixing and flipping. It's not easy. The hardest part, by the way, that people need to understand about fixing and flipping, you make your money when you buy the house.
Can you explain that? Because I hear you say that, but it kind of clicks for me, but not really.
Okay, well, it doesn't matter how cheap of labor you can find. It doesn't matter how amazing your kitchen remodel is. It doesn't matter how amazing your landscape architect is and how you're going to do all the landscape yourself and you're going to save tens of thousands of dollars. If you buy a house for X, you know you're only going to be able to sell it for Y. Y is the market value. Okay, it doesn't matter how good you are at decorating and fixing and how cheap you can get supplies and how cheap you can get labor. If you bought the house for too high of a price and you do everything to it that you want, you can still only sell it for what the market says the home is worth. So you don't make your money based on how quickly you get it fixed up, how cheaply you get it fixed up, how amazing that color of paint looks inside. Or you don't make your money because you decided, hey, I don't need to like actually replace the roof. All I need to do is pressure wash and treat the roof, at which point it'll serve the same purpose. That's how you optimize profit, sure. You know, turn something quickly, find cheap labor, use the right color paint so that you elicit the highest offers. Those are ways you optimize profits. But you make your money based on how you buy it. You need to buy something cheap enough so that you allow yourself the opportunity to improve it and then sell it for whatever the maximum the market is currently giving. So you make your money when you buy it. So there are people who can make money fixing and flipping. There's some people who do it full time. That's all they do. There's some people who no, they do it 2 to 4 times a year. Know this about fixing and flipping. A, the hard part's finding the deal. That's the hard part. We had David Buckles on this show about a month ago. He is a very successful real estate investor. He knows this fix and flip game inside and out. His advice is partner with the real estate community. Tell them what you're looking for. let them bring you the deals. Now you have to know how to value the deals. You have to learn how to know, well, what is the right offer in order to make sure I can make a profit. Like, oh yes, all of that is, you got to learn. And most times we learn by doing. But you have to make sure you're buying it right, which means you're buying it low enough. The hardest part, though, is finding the deal. There's some people who, how do they find the deal? They put out ugly yellow signs. Will pay cash. You all see them at every intersection.
Do people actually call those, by the way?
Obviously, John, they're being used for the past 20 years. Yeah, they do work.
Okay.
People will use services like PropStream. They'll pull data lists. Then they'll call and text those lists. Those are the annoying texts a lot of homeowners are getting right now. Looking to sell your house? Cool. I mean, again, they work at what percentage? Oh, probably 1%, right? They send out 1,000 texts in order to get 20 people to respond, in order to get 3 people to let you come out and look at their home, in order to have one person. You know, it's like, it's a numbers game for them. But the hardest part people need to understand is actually finding the home. Right? Some people send mailers. Mailers are super expensive. First, you have to figure out, who am I going to mail? David Buckles says work with a title company. They can supply you a list, but you still have to pay for the actual postcard, the actual postage. Yep. So again, that would be fix and flip. Here's something to also understand on fix and flip. It's probably the hardest place to make $1 million. I mean, you think about it, it's very transactional. I buy this house for $300,000. It's going to be worth $450,000 when I'm done fixing it up, but I need $50,000 to fix it up. Plus, I spent however much money carrying the property. Things like property taxes, things like insurance, things like interest on the loan. Because you can go out and use other people's money, OPM, to buy fix and flips. It's called a hard money loan or a private loan. It is available. Now, you'll need a larger down payment than 0 to 3%. More than likely, you may need about 25%. You look at how much it's going to cost to acquire the property plus do the rehab, you're probably going to need about 20 to 30% of that overall budget. But you don't need the full amount. You don't need to go out and drop $300,000 cash to buy it and then another $50,000 to rehab it, etc. No, you can get a loan, but that loan will come with interest, and interest on those loans are somewhere between 9 and 12%.
Yo,
typically.
what? So what type of investor or person would go after like hard money loans? Because I hear people say it sounds like a sexy term, like, yeah, use hard money on that.
Yeah,
like,
anyone who's looking to fix and flip.
Okay.
It's a short-term finance. Okay. That's why the interest rate. And it's risky because you're typically buying it in your LLC. The home's typically in disrepair, and the lender knows that you're going to be paying them off quickly. Lenders don't want you to pay them off quickly.
Nope.
Lenders want you to pay them for 3 to 5 years and then go get a new loan with them.
They don't like EPOs, ladies and gentlemen.
No, early payoffs. They do not like EPOs, and they hate EPDs.
What are those?
Early payment defaults. That's worse. Woo. I gave you a loan, and within like 6 months, you're not making the payment on time?
Come on, homie.
Yeah, we did something wrong.
Right.
But no, fix and flip is definitely the harder way because it's very transactional. Most real estate investors fix and flip to raise revenue. They then use that revenue to do our third of 5 strategies, which is the investor buy and hold. I'm not saying you can't make $1 million fixing and flipping. Right, at the end of the day, do the math. You go out and do 15 to 20 fix and flips where you're netting somewhere between $50,000 and $75,000 per fix and flip. Yeah, that's $1 million. That's $1 million straight cash. Most people who are full-time fix and flippers, if they're successful, they're bringing down $120,000 to $300,000 a year. Great living, by the way. Great living, especially working for yourself, making your own schedule. But at the end of the day, when they do their expenses subtracted from their gross revenue to get their net revenue, it's going to put about $120,000 to $300,000 in their pocket. That doesn't mean there aren't fix and flippers out there making $300,000, $600,000, $900,000 a year. I know one personally. Like, he's here in Orlando. The guy crushes it. But most people use fix and flip as a way to raise capital so that they can buy and hold. Buy and hold is where it's at.
What does it mean? Like, I see this dirt lot, I'll buy and hold until they build stuff around it and then sell.
Well, buy and hold is very similar to the traditional kind of house hack, right? The traditional house hack is just buying your primary house. Like, someone could legitimately buy a primary house today for $600,000, put their 3 to 5% down, and then in 30 years, the house is worth 1.5 million. Bingo, bongo, bango, they got $1 million bucks.
Yeah, okay.
Like, that's just traditional, straight up. Hey, buy a house for you to live in. Or what I described in this episode was buy a house to live in, 3, 5, or 7 years, buy another house, but keep the first one.
Mm-hmm.
3, 5, or 7 years later, buy another house, but keep that one and the original one. Do it one more time, now you own 4 homes. Do it a last time, now you own 5, one that you live in, 4 that are rentals. Mm-hmm. And now at the end of the day, when you're ready to retire, you have those 5 properties that essentially at this point, if they're not owned free and clear, you probably owe, gosh, I'm going to guess $500,000, but the homes are worth well over $1.5 million. So you take $1.5 million that the homes are worth minus the $500,000 that maybe you owe collectively across 4 or 5 mortgages, you still got $1 million bucks in there, if not more. The buy and hold is a little bit more intentional, where they're like, nah, look, I love my house. Love my house, don't want to mess with it, love my life, love my lifestyle, love my neighbors, love my neighborhood. Love the schools. Don't mess with my home. But I would like to go out and acquire 2 properties a year. And maybe these people are making good money, or maybe they have decent money socked away somewhere else. And they're like, look, they call someone like me or any other mortgage loan originator out there, like, hey, Dio, what do I need to buy an investment property? And I'm going to answer quickly. Look, 20 to 30% down, get you started. All right, cool. If they have it, let's talk about how they can go out and put 20 to 30% down and start buying investment properties. Typically, when you're buying investment properties for this strategy called the buy and hold strategy, you're not looking to cash flow. You hear a lot of people talk about, oh, I want to cash flow. Yeah, I don't know. Like, I want my wife to be nice to me. But it doesn't happen every day. Most days, yes, but not every day. When you're looking to buy real estate, especially buy and hold, you're less concerned about cash flow. You're looking more to cover your cost. Let someone else pay down the loan while the home appreciates. That's where you're making your money. If it cash flows, fantastic. And there's ways that you can cash flow, right? Like there's this thing called pad split. And a buy and hold real estate investor in certain markets, in certain communities, you could go buy a 4-bedroom house, convert it into a 6 or 7-bedroom house, and then partner with this company called Pad Split. And then Pad Split will rent each room weekly.
What?
Yeah.
What is this, a hostel?
You basically, yeah. Watch out where you live, because you're in an unincorporated area without an HOA. Yeah, easily go in there. Plus, where you live, a lot of people are on like 1 to 3 acres, lots of parking. The issue when you start doing pad splits is you have a parking issue. But nonetheless, that is something that people who are in the real estate game looking to buy and hold, they do that because that's how they cash flow. But most people, they're less concerned about cash flow. Here's what they want to do. They want to be able to pick up 2 or 3 properties every few years so that after a decade, they have 10 properties. They have 10 properties that, let's say each home was worth $3 million. I'm not sorry, $300,000 when they bought it. Just I'm using just kind of roundabout numbers. So $300,000, that means that each property required them to put somewhere around 70 to 75 grand into the property. But this was a way for someone over a decade to take what was $750,000 of their money. They're able to put it into 10 properties, so spread it out, $75,000 per property. But now they own 10 properties that they have purchased over a 10-year period of time. And all 10 properties are rented. All 10 properties have enough rental income that cover the cost. So part of that cost is their note. Part of their note is principal payments. So someone else is paying down their principal while their home goes up in value. So they own $3 million in real estate, of which they had to put $750 grand out of their pocket, which is equity. It's still their money, right? They just took that money from the savings account, checking account, an IRA, a 401k, wherever it was, E-Trade, and then they put it into equity. So it wasn't like they spent the money the way that you'd want to spend it on some like world cruise. No, they just transferred the money from one investment into another investment. But now they have $3 million in real estate that hopefully is going up on average by 3% per year, which is roughly 90 grand. So every year their home's appreciated by 90 grand compounded, and every year the renters are paying down their note. And let's say the renter was paying down their note by on average $4,000 per property or $40,000. So someone else paid down their note 40 grand that year. Their homes went up in value by 90 grand. You do that for 10 years, over $1 million in equity, just like that. That, to me, is probably the more preferred method. The difficult part is people need to come up with 20 or 30% down. That's hard to do. But, John, what if you purchased your property 10 years ago? Right? 10 years ago, you were long-term, serious girlfriend. You were a college graduate. Were you married 10 years ago?
Yeah. No, not yet.
Getting married, though.
Yeah.
Yeah. Bought your house. Picked that thing up for $180. 10 years later, because you live in Central Florida, it's worth $400,000. You've paid down your loan from owing $180 to now you owe $140.
What?
You have all of this equity. You know what you could do, John?
Get rid of the wife and spend the equity living my life the way I want to?
Potentially. Potentially. That's short-lived and it does not make good content for TLOP, damn it.
No. What could I do with the money that I've earned in equity in my home, Dustin?
You could go do a cash-out refinance on your house. Maybe you don't want to because rates are still, in the mid-sixes. Or you could go get a home equity line of credit. Let's say you went and got a home equity line of credit for $100 grand. Because you keep in mind, you owe roughly $140, your home's worth $400. You have $260,000 of equity. I'm not asking you to tap into all your equity. You could take $100,000 of that equity. Now you could go afford 2 rental properties at least, if not 3. Use that $100 grand. All you're doing is transferring equity from the first property that you ever bought, the only property you own. You're transferring that equity into 2 other properties. But now those 2 other properties have renters in them. And now instead of you owning one piece of real estate that's worth $400 grand, you own one piece of real estate that you live in worth $400, plus you own 2 rental properties, each worth $300 a piece, so $600 grand. Now you own $1 million in real estate. Now you do owe.
That's what I'm about to say.
$140 on your current mortgage, $100 grand on your HELOC, and you owe the 2 mortgages that you took out to purchase these properties.
Yeah.
So right now, day one, you're no more wealthy than you were when you
Hell
started.
no. I went from-
However, John.
I went from 1 bill to 3, 4. What the hell?
Yeah, you did.
What the hell? Yeah,
you did. And from 1 headache to 3. Truth be told.
Yeah.
Yeah. Like, look, if it's easy, everyone would do it. It takes work. It's going to add stress.
I have a question for you, honestly, for the ignorant people out there. Dustin, ain't nobody got time for that. What is the quickest, fastest way for me to make $1 million just dabbling in real estate? Is there like a quick? There's not like, hey, in a year I can make $1 million just off the street. It's not like a quick. There's no quick. Snap my fingers.
Yeah, there is. I'll end the show with it. Yeah, make another 10 minutes and I'll end the show with answering that question.
Okay.
Yeah, because there's always an outlier.
That's what yeah.
There's always an outlier. And I'll tell you a personal story with people that I actually know.
I knew it was in there somewhere.
Okay. But to finish what I was getting at, you have taken that $100,000 out of your house. You had over 200. You just used some of it. You're not spending it, right? You're not going down to the Dominican Republic and living the best life ever.
Damn it.
No, you're just transferring it from one property into 2 others. But now, instead of your one $400,000 house going up by 3% per year, you now have that one plus 2 other homes, each worth $300 a piece, so $600 grand, now going up in value. Now, that means an extra, John, 6 times 3 is 18. Another $18,000 a year you're gaining in appreciation. And those renters are paying down your loan by roughly $4,000 to $5,000 a year. By the way, that's up front. As you get to year 7 and year 13 and year 20, a lot more is going towards principal. But in the very beginning, if you look at it, what's called an amortization schedule, you'll see that your interest is front loaded. So when you're paying your mortgage servicer or the holder of your note, the bulk of your payments in those first 7 years go to interest. It's not until you've had the loan for a while that the bulk of your payment starts going towards principal. But nonetheless, even worst case, that's $4,000 to $5,000 a year times 2 properties, $8,000 to $10,000. So it went up $18,000, and someone else paid down your loan by another $10,000. That's $28,000. For doing what? Now you did take on a little bit of extra headache, right? Because now you have landlords, now you have a leasing company, now you have a couple more bills to pay, a couple more things to track. Sure, but again, like that's life. No pain, no gain. If nothing changes, nothing changes. Yes, you got to make a couple changes. You got to be willing to accept some more responsibility. You also have to be willing to take a little bit of a calculated risk. And then for my, so I don't get too long here. For my business owners, y'all, look at the office space or the warehouse space or the shop that you currently operate out of, and you figure out a way. This is number 4. You figure out a way to buy your own building. Look into an SBA loan. An SBA loan for small businesses is like an FHA loan for first-time home buyers.
I understand that. I understand
hey,
that.
if it ends in A, what is it?
It's a government loan.
It's a government loan. SBA, Small Business Administration.
No shit. It's a Govy loan?
It's a Govy loan.
Okay.
Yes, it's a Govy loan, and as long as you're going to occupy the bulk of the space or a certain percentage of the space, SBA loans allow business owners to own real estate with limited amount of money down.
Damn.
At very favorable terms. So like I have a cousin that she and her husband crushed it, 20, 30 years, crushed it running their business, right? And their business was a auto body shop. They had 2 locations, right? You got in a car accident, you wanted to go take your car into Ray's shop and let Ray and his crew fix it up. But I'm going to promise you this, and they crushed it. They did really good. Well known in their local community. You know where they made their money, though?
Where?
In real estate. Yes. Hey, I need a shop. I need a lot. Well, do I want to rent from someone else or do I want to own? Well, if I can go to the bank and I can get it financed, whether I'm paying $10,000 to my landlord to rent his shop on his piece of land, or I'm paying $10,000 to service a debt that I used to purchase this.
For sure.
And then what happens? He owns his business for 10 years, 20 years, 30 years. When he wants to retire, sure, someone's going to come in and buy his business. But you know what is worth the most money?
That damn land.
It's not the business. It's that land.
Yeah.
It's the land and the building that sits on top of the land.
You should tell Winn-Dixie that.
I should tell Winn-Dixie that. Yeah, so funny story. It's funny you bring that up, John. Winn-Dixie, my understanding, and I'm related through marriage to someone who once represented Winn-Dixie. I don't believe that their business strategy is one in which that they own a lot of their stores. They actually enter into what are called 99-year leases. And I don't know enough about commercial real estate. I always just found that to be funny. Like we're like CVS Pharmacy, they like to own their real estate.
That's interesting.
Like I've done loans for people who own McDonald's franchises.
Yeah.
Oh, you know where people who own McDonald's franchises make all their money, John?
Where? Selling fries?
No, not selling fries, although their fries are still some of the best in the world.
Yeah.
Right beneath, bowling alley fries. Bowling alley fries, those crinkle fries at bowling alleys are number 1.
Yeah.
McDonald's French fries probably number 2.
Okay.
They make their money by owning the real estate. That's where they make their money. If you know someone who owns 3 or 4 McDonald's franchises, sure, each McDonald's franchise can spit off $50 to $100 a year in personal income, but it's the real estate. So for anyone who owns their own business, finding a way to purchase. Heck, a buddy of mine, shout out to Andy Burton. I just saw Andy. He crushes it in the mortgage industry. He's been a guest on the show.
Yeah.
Yep. Andy just bought a building.
No way.
Yeah, up in Woodbury, Minnesota, where he operates out of. Because here's the deal. Andy is a producing branch manager. Most producing branch managers in the mortgage industry operate off of some kind of a P&L, right? Meaning that their compensation somehow is tied, whether it's an override or however it's done legally, it's tied to the economic stability of their branch. Well, Andy's like, look, I'm already paying my landlord X amount of dollars. What if I could just buy the building as Burton Family LLC, and then my mortgage branch will rent from me?
The hell? Hell yeah.
Yes, right? So like that's number 4 is think commercially. And here's something that my business partners in our fix and flip business taught me.
Okay.
If you can fix and flip a condo or a mobile home or a single family home or a duplex, why can't you fix and flip an 8 or 12 unit? Why can't you fix and flip a 24 unit, a 60 unit, an 84 unit, a 100 unit? All you're doing is moving commas.
Yeah, the numbers are bigger than one.
That's it, though. Yeah, but the same principles apply. The same exact principles. You got to find the property. You got to find the financing. You got to add value. Add value means fix it up. And then in that world, you re-rent it at a higher rent roll. And then you go take out permanent financing, but at the new value. Right? Like, little bit of a tease on how to make money buying multifamily. But just understand, once you can wrap your head around the concept of buying something for cheap and fixing it up, you then have to figure out, do you want to keep it or do you want to sell it? Do you want to flip it or do you want to hold it? And then you'll learn other strategies like the BRRRR method. The BRRRR method is buy,
Rehab,
rehab,
rinse, repeat.
refinance, repeat. You refinance because what you do is you buy it, you make it more valuable. Once you make it more valuable, then you rent it for a higher amount than what it rented for before you improved it. Once it's rented, you then can go to a bank and say, look, at this beautiful home that I remodeled that I'm renting for X, have them give you enough money to pay off whoever helped you finance the acquisition, hopefully maybe and give you a little bit more than what you put into it, right? And then you go repeat it. So anyhow, that's, again, we digress a little bit because that is a whole entire show. And we've covered it various times with Cameron Moore or with John O'Leary on the show or David Buckles recently. But just understand, if you're going to get into fix and flip and buy and hold and become a real estate investor, you should know BRRRR. You should Google the BRRRR method and understand what BRRRR stands for. And then I wanted to share with you, yes, you can make millions buying commercial real estate. You would start, especially if you're some kind of a business owner, or even like an Andy Burton, who he doesn't own the mortgage company he works for, but he has a say in where they're going to rent space from, what they're willing to pay, and what type of space they're looking for. There are ways to make millions. And then just because we were talking about it, yes, if you can fix and flip a condo, a mobile home, a single family home, a duplex, then you should know you can also fix and flip a 12 unit or a 24 unit, a 60 unit or a 100 unit. Shout out to Stacy Conti, who was on our show most recently. I mean, Stacy did that with a dilapidated Roach Motel. She literally bought it, fixed it up, and now she turned it into the cutest boutique motel that she basically Airbnbs because out by the beach. All right, and the last one is for people who are just getting started. Maybe you don't have time. Maybe you can't handle the stress, right? Maybe you don't want to take on more because you're out of bandwidth. You can become what's called an LP or a limited partner, right? So think about this, limited partner. My buddy, Steve Curley, is wanting to go out and buy an entire development. He's going to partner with a general contractor. So Steve's going to supply the financing. The general contractor supplies the know-how. And the total project is a $6 million project. And Steve can raise or go to the bank, and the bank will easily give them 70% of $6 million. They'll give them $4.2 million.
Yeah, what the hell?
But they're short $1.8 million. Well, what if you could come up with 25 grand or 50 grand or 100 grand, and you knew someone like my buddy Steve, you could go in as a limited partner. Because what these guys are trying to do, the general contractor and Steve, who's the commercial real estate developer, what they're trying to do is they did the hard part, which is they found the land, they negotiated the sales price, they know how to build homes, they have all the subs, they have all the vendor contacts. What they want to do is not put any money out of their pocket. They're trying to use OPM, right? So they went to the bank, and the bank's like, yeah, Steve, we underwrote you. You know what you're doing. General contractor, we underwrote you. You know what you're doing. But as the bank, we're only going to give you 70% of your project. You have to come up with the other 30%. Steve and the GC have to decide, well, do I want to come up with 900 grand as the GC and Steve come up with 900 grand? Or do I want to sell bits and pieces of this opportunity to other people? Do I want to make them limited partners? Right? They're the general partners. They're in charge. This is their circus. We just come in, and you may only have 25 grand, but I may have 100 grand. If we collectively can help them raise the $1.8 million, they will essentially sell us, quote unquote, shares in this project. It's a great way for me to get started. I can be someone else's private investor. And you can do it at a small scale or at a large scale. Sometimes they call that bridge financing. Hey, I'm going to go to a bank to get my primary financing. I need to go to private investors to get some bridge financing. You could very well be a person who is a bridge finance. That's a good way to get started. Now, I don't know if you're going to be able to make millions right at the gates. It'll be a longer play. But what if you invested 100 grand? So instead of buying 2 properties, like we talked about, you used your HELOC to invest in this project. And this project probably paid you 8 to 12% guaranteed interest on your money, plus they maybe gave you a percent of the profits. And maybe the percent of the profits was like 2%. But what if they turned the $6 million venture into a $10 million gross sale, which was $4 million in profit, and you get 2% of $4 million? Oh, all right, there's 80 grand, John. You turned your 100 grand into 80 plus the interest that you accumulated while the project was being built. 9 months, 18 months, 36 months, however long it took. Rinse and repeat. Now you have the 100 grand you started with. You have the 80 grand that you made plus the interest. Maybe you take 200 grand into the next project. Same thing happens. Then you take 400 grand. Maybe on the side, you realize, wait a minute, I'm going to put 50 grand into another project, right? This is how it's done. You have to compound your successes, compound your efforts. You can start small and you can build it up. So that right there, ladies and gentlemen, 5 ways that you can become a millionaire through real estate.
What was that story you promised me about something personal?
All right. If you know a really rich friend
Yeah.
who's looking to hook his brother up,
Yeah.
you too could just get invited into a big pop. Right place, right time, knowing the right people. Your net worth is the sum of what, John?
Your network.
Yeah. Yeah. You are the sum of the company you keep. Who are you hanging out with? What types of things are these people into? What types of things are these people talking about? What type of dreams, goals, and aspirations do these people have? Do they align with yours? Buddy of mine, he has himself a really rich friend. By the way, self-made too, which is amazing. Self-made. Like this guy and his father had a family business that was passed down. And back like 15 years ago, they sold the family business and they started investing in real estate. True story. Started investing in real estate. Maybe bought a couple properties. Commercial, right? They probably made about $1 million, $2 million bucks from selling the family business, which that's really good money, but it's not enough money to like be like, yep, I'm done working. Not for dad and son. Now, if dad was like 70, sure. But no. Dad and son started buying, and they bought real estate at the best time. Like if you're buying real estate 2009, 10, 11, 12, 13, like it was a great time to buy some real estate. But nonetheless, they cashed out on one business. They doubled down into real estate. Today, they own hotels. Hotels in Miami.
Monopoly.
Yeah, they own yachts. Own yachts.
Plural.
Just 15 years later, you know?
Yeah.
So my buddy, best friends with this guy since like high school. And this guy, he doesn't need my buddy or my buddy's money, but they're boys. He's looking out for his own. He reached out to him, was like, hey, man, I have an opportunity. One of my attorneys brought me this opportunity to buy this farm. And we're going to buy the farm, but we got to act quick. How much money can you come up with? And my buddy, if you know him, man, he is like balls to the wall. Like just whatever, man. He's like, I'll cash in my 401k
right now.
I'll pay all the fees and all the penalties. How much money? I mean, literally.
Okay.
Yeah. I'll cash in the kids' 529. I'll sell my wife's car. She doesn't need it. She can Uber the grocery store. You know, like one of those guys.
Yeah.
But he did it right, and his friend said to him, look, I'm gonna pay whatever you can't come up with. So let's say my buddy came up with like 300 or 400 grand.
Okay.
His buddy came up with the other probably million and a half.
Yeah.
But they bought this farm and within 9 months sold it.
No.
Yeah, each of them took home like 900 grand.
That's the outlier.
Yeah, it is the outlier. That's why we talk about it. That's why.
But that's such a cool. I know this is a good story.
Yeah.
Buy a farm.
Yeah. And truth be told, my buddy who has that same mentality, yeah, he can also tell you stories about how he lost it all and rebuilt. Right? Because most people have been willing to take calculated risk, and not every calculated risk works the way you anticipated it to work. What you need is for it to work most of the time. Most of the time. Like we've talked off and on about my involvement in seed funding or angel investing, right? I have a decent amount of money spread out amongst like 12 or 13 different companies. I understand that there's going to be 2 or 3 that I lose it all. There's going to be 5 or 6 that I lose some or I break even. but there's going to be 2 or 3.
Shit.
Yeah.
That pays daddy.
That pays daddy, just like we talk about. That pays daddy. So, no, man, I hope you all enjoyed this episode. Yeah. I hope you got a lot out of it. We talk about our website a lot to the mortgage professionals who tune in. I'm going to make a promise today.
Okay.
To our real estate investors, whether you're full-blown successful, you're part-time, or you're wanting to become a real estate investor. The same thing that we're doing right now on TLOPonline.com, TLOP online.com. The same thing we're doing for the mortgage community, we're going to do for you.
Uh-oh.
We're going to do for you, John. You're going to freak out when I tell them this, but we're going to start opening up channels and pages specifically geared towards offering you educational content and resources that some of the best in the business currently utilize. And eventually, we're going to bring in guys like David Buckles and Cameron Moore, and we're going to ask them to start offering some kind of coaching services to our TLOP listeners and our TLOP fans.
There you go.
Right now, if you go to the website, you're going to see it's primarily for our mortgage friends. But we're going to do the same thing for you all. We will have that launched by Q1 of 24.
There you go, Dustin.
Q1 of 24, we're going to have this launched.
Anytime you start talking in time frames of Q1 and Qs, you know it's something serious.
It is something serious. But hey, his name is John Coleman. My name is Dustin Owen. We appreciate you tuning in. Please make sure if you're tuning in for the first time, you're liking us, you're giving us a 5-star review, you're sharing us to anyone that you know that is looking to get edutained on all matters financial. Edumatained. Follow us on social. We are at the Loan Officer Podcast. And if you ever want to connect with me, the individual, LinkedIn's probably the best. I am Dustin Owen on LinkedIn. That is all the time we have for you today, but we will catch you on the next episode.
Bye.